really excited to introduce Meltem. As I mentioned earlier, I think you'll really enjoy her. She's the Vice President of Development at Digital Currency Group, which is a very cool group. They build, buy, support digital currencies and blockchain technology. So there's part venture fund, part currency trader, part incubator. And they do all this by leveraging their deep insight and network and access to capital. So it's a real treat to welcome Meltem.
So everyone has drinks. We're good. We're going to keep it casual tonight. I'm going to talk for a bit, but when your eyes start glazing over, I'm going to stop talking, and then we're going to start the rapid fire question round. All right. So what I mentioned to you, first of all, disclosure. So very important to me is disclosure in this ecosystem. So I hold a lot of different cryptocurrencies and tokens. These are all of the tokens I hold. This presentation is on SlideShare. So if you find me on LinkedIn, if you Google my name, you'll find this. There are 3 additions that I need to make here. I also recently invested in a project called Mainframe, a project called Haven, and a project called Handshake. I'm not paid by any project that creates cryptocurrencies at the moment. I don't advise anyone that's creating cryptocurrency. I'm not paid to market any tokens or projects, but if and when that changes, I will update my disclosure. Also, this is not investment advice, so don't take it as such. It's really scary because the most clipped slides from my presentations are the disclosure slides, which makes me think that people are buying the stuff I buy, which is not a good strategy. So what I want to talk about quickly is how did we get to the point we're at today? And the point we're at today is you cannot go anywhere without people talking about, asking about, arguing about cryptocurrencies and tokens. My Uber driver the other day told me that Ripple was going to $10 and that I should buy it before I miss the opportunity. So this is the reality we live in. How did we get here? Then I'm going to talk a bit about why I think this is happening. I'm going to talk about history. So the internet boom had a lot of interesting analogies, but my takeaway is that history rhymes, but it certainly doesn't repeat. And I want to talk about what's different this time that makes this so interesting to me. And then I'm going to talk a little bit about what I think is going to happen next and what it means for venture, not just as sort of a job or a role that people play, but what it means for venture in the context of capital formation and what it means for the way that entrepreneurs and innovators will fund their companies, their ideas in the future, and the profound impact I think that will have on humanity, because I think it's truly game-changing for a lot of what we believe to be true in this world. I think it's going to challenge a lot of those mental models that we've all sort of grown up with. Does that sound good? Yeah. All right, let's go. So Bitcoin, everyone here has heard of Bitcoin, yes? Has anyone not heard of Bitcoin? All right, no one's living under a rock, that's good. So it started with Bitcoin, and what I think is really important to remember is the year today is 2018, but Bitcoin started in 2009. We've been at it for almost 10 years, and it really started back here when this white paper was released. And I'm not gonna pretend that I was there and reading it in 2009. I got onto Bitcoin like in here somewhere, but it doesn't matter when you got into it. Basically what happened from about 2009 till about 2012, it was just a bunch of people on the internet talking about this cool idea. Could we create digital money? What would that look like? And this has been tried before. In the 90s, people were trying it on the internet. There are ideas like eCash or Hashcash that were early iterations of this concept. But Bitcoin was really innovative in a number of different ways. And so all these people online said, hey, why don't we build this system that's talked about in this paper that's anonymously been published online, and let's implement it. So the Bitcoin network was implemented in 2010, and it started running. People started running this protocol on their computers. And when I got to MIT in 2013 to go to grad school, which is a very expensive exercise, people there were mining. You could go online and use something called a faucet, where you basically get given Bitcoin because it was pretty worthless. But around 2013, what started happening is we saw companies start to form that said, hey, this Bitcoin thing might actually be something. What if we provided people the ability to buy and sell this stuff? What did that look like? So there's a company, YC class of summer 2013, called Coinbase. Who here has heard of Coinbase? Great. Said, hey, let's make it easy for people to buy Bitcoin using ACH and wire transfer. So that's all they did. It's now one of the most valuable companies in this industry and one of the most valuable venture-backed companies in Silicon Valley, which is pretty amazing. Then what we saw is people said, oh, like this Bitcoin thing, we need a bunch of infrastructure. How do people buy and sell it for US dollars? It's like this weird online money. What do we do with that? How do we allow people to mine it or run the network around it? How do you have people hold it? How do you hold digital money? There are no banks to give it to, so what are you going to do? You need wallets. You need different payment processors. Then on top of that, people started saying, well, if this is going to become an institutional asset like we want it to be, we need security, we need trading tools, we need institutional infrastructure. And it really wasn't until 2015, so all the way over here, that you could even send a Bitcoin transaction from the US to India, put USD in on the US side, send your Bitcoin from the US to an exchange in India, and cash out rupees on the other side. So that took 6 years. So this whole Bitcoin thing is not new. There are a bunch of people who've been working on it for the last 9 years. And in 2015, when you started being able to send payments around the world, what we realized is we've created an open, permissionless financial system. So what does that mean? So today, if I want to send you money, let's say, what's your name?
Imtiaz.
Imtiaz. I'm Meltem. Nice to meet you. So if I wanted to send Imtiaz money today, what I would need to do is I would go to my bank, and I would say, hey, I want to send Imtiaz money. I would need to get your bank details. Or we could do PayPal or Venmo, but I'm on PayPal, you're on Venmo. So either you have to get on Venmo or I have to get on PayPal. But let's say we're going to go through our banks. I go to my bank and I say, hey, I want to send Imtiaz money. And they say, okay. We're going to check to make sure that you're allowed to send him money. And so I have to get permission. And then it takes a couple of days for you to get the money. And then you have to get permission from your bank to receive it from me. They have to say, oh, is she legit? Okay, good. And then you can have your money. The idea of Bitcoin was, what if we removed all of those intermediary steps and we went back to true peer-to-peer transacting, where the only thing Imtiaz and I now have to do is I go to Imtiaz and I say, hey, I'm going to send you money. He says, great. I say, give me your address. He gives me his public address, his public key, and I can go on the Bitcoin network. It's just a piece of software that I can run on my laptop. Well, now you can't run it on your laptop anymore. We'll talk about that. And I just type in his address, I hit send, and 10 minutes later, he gets his Bitcoin. Okay, does anyone realize how transformative that is? Here in the US, we have good payment infrastructure. Every person in this room has a bank account, has a credit card, can access financial services. For 3 billion people on this planet, that is not a reality. For 100 million people in this country, that's not a reality. So the idea of an open, permissionless financial system is fundamentally transformative. And once people realized that about Bitcoin, they said, let's do this blockchain thing. So a bunch of banks got together and they said, we like the idea of the Bitcoin blockchain or this network where you can send money around, but we don't want to have this Bitcoin thing. Why would we let someone else make their own money? Let's use our money, but use this blockchain thing. And so from about 2015 to 2017, I like to call this the dark ages of Bitcoin, because there was really not a lot of work happening in the Bitcoin space. Everyone was focused on the blockchain. Now, I don't know what the blockchain really is. It's just an implementation of a protocol or a software system. But everyone got obsessed with the blockchain. We saw a lot of new protocols form that had no token. They just said, look, let's create a network that allows people to share data, that allows people to share information, that allows people to share one common data repository, one version of the truth, and let's start to implement that. So I don't want to talk about blockchain today because I find it fundamentally uninteresting. I want to focus more on cryptocurrencies because I think they're more transformative. But that really took up 2 years of time. But what happened then in 2017, this idea of tokens really started to take off. And I'm calling 2018 the year of tokens. So if anyone wants to join me in that, and you heard it here first. But what we're starting to see is hundreds and thousands of projects that are emerging that are capturing value in new ways. And the idea really is if networks are what creates value in our world, you think of every business you're investing in as a venture capitalist. It's a network, it's a marketplace, it's an ecosystem, it's a community. Everyone's trying to build these massive networks, and they're capturing value in the whole stack. What people are trying to do with cryptocurrencies is change the way that value capture works in a network. And so the way I sort of characterize tokens is there are core protocols like Bitcoin, like Ethereum, Ripple, Litecoin, others that really are used. The network is up most of the time. You can transact in these core currencies, and they have a native token that enables you to transact in different ways on these networks. Then you have a lot of emerging protocols. So these are people implementing new forms of consensus, where basically the token plays the exact same role, but these protocols are newly created. They're implementing a new type of way of sharing data that hasn't really been tested in the wild yet. So these will take some time to develop and sort of be more liquid. And then on top of that, what people started to do is say, hey, what if we use existing blockchain protocols, and instead of rolling our own blockchain, which is really hard to do because it's very easy to mess up consensus, what if we created application ecosystems that had their own native token just specific to that application? So that's kind of the world we're living in today, and different people will explain it different ways, but this is what I find helpful. And so what's happening here? Why does it look this way? Why is this happening? So the way I like to explain a blockchain kind of top to bottom is you start really at the core with something called the protocol layer, and this is like where the nerds like to hang out, is down here. But really what a protocol is, it's just languages and rules that define a system. And in a lot of different cryptocurrency protocols, what that means, it's the monetary system or the economic system that governs how tokens get issued, who's allowed to access the network, who can create or destroy tokens, is that even possible, is there inflation, are there a fixed number of tokens, etc. But really all a protocol is it's a piece of software. And that software becomes a living, breathing thing when you implement it at the networking layer. And at the networking layer, really what it is, it's a bunch of machines around the world running the protocol, and there are different types of ways you can structure the network. But really what it does is the networking layer enables people to interact with the protocol, and it also enables people to earn tokens in some constructs. There are network operators that play different roles in these systems of validating certain types of transactions or data entering the network. And then on top of the network, once the network's sort of widely distributed and widely implemented, people start to build applications. And what you and I and your average user will interact with is the application layer. And so what's really fun is if we go back to the internet, how many people here were investing or building companies during the internet boom in late 90s, early 2000s? Awesome. Okay, I was in middle school and I was using the internet, so I wasn't where you were. But what I think is interesting is if you look at history, right? Like I said, history rhymes, but I don't think it repeats. If we look at the way the internet developed, really from the 80s till about the mid-90s, a lot of the work around the internet was done on protocols. So how are we going to communicate on the internet? What is the standard protocol we're going to use to send a message, right? What is the standard language we'll use to write emails, which was messaging on the internet? What's the standard protocol we're going to use to send files, right? That was FTP. What is the standard protocol we're going to use for namespacing? DNS. So we had to create all of the rules and languages of the internet ecosystem. And then we started implementing the network. And the network, again, super capital intensive. ISPs had to lay thousands of miles of fiber to connect people on this new network. There was also hardware devices that people had to buy and run in their homes. So we all have internet networking hardware in our homes. We have modems and we have routers. And then on top of that, people started building applications. So to me, the internet was fundamentally an innovation in information transfer, how we connect data and share it in a networked sort of structure. And really the killer app to me for the internet was email or instant real-time messaging. Some people say browser. We can argue the merits of both. But if you think about what happened, we started with this core functionality, this core feature of can we send real-time communications for low to no cost? That was the internet. Right? I remember being online on AIM and on messaging boards, and that was really cool. I'd never been able to do that before. And so really what started happening from there is once the network got built, once that killer application got built, you started to see all sorts of other applications get conceptualized, like file sharing, cloud computing, all of these things that leverage that same network, but for really cool stuff we didn't even know was possible yet. So let's go over here. So we were living in internet world, and now we're living in blockchain world. So just like the internet is an innovation in information transfer, I believe that the blockchain is an innovation in value transfer. Does that make sense? Yes. Nod. Yes. Excellent. Okay. But I want to say value, in the world we've lived in for the last 3 millennia, value has meant money. But value doesn't mean money in our world. There are so many types of value that we don't account for today in any formal sort of way. like cultural capital, like human capital, like social capital, right? Like you kind of remember if when you did a favor for your friend, they helped you back, but we don't have any systems that allow us to account for any other type of capital. And what the blockchain is it's an innovation that allows us to capture value in a new way. And it doesn't have to be financial. Again, if we go back to this sort of stack, the protocols we're working with today are things like Bitcoin, Ethereum, IPFS, which is a file storage protocol, Blockstack, which is working on addressing namespacing. We have the network. So today, the implementation of these networks is widely distributed in the case of Bitcoin, but highly industrialized. And in the cases of other networks, it's not that widely distributed. So the networking layer is really being worked on today. It's very sporadic and intermittent. But really, the first killer app of blockchain was Bitcoin. This open, permissionless financial system was fundamentally innovative. But that's not all the blockchain is about. There's so much more we can do with it. Smart contracts are something people talk about a lot. I like to call it programmable money, but I know people have strong feelings about that. Distributed computing at scale is now possible. Tokenization of all types of assets is possible. But again, I want you to be expansive in your thinking about what value means. With blockchain technology, what we're trying to do is we're trying to help humanity capture a lot of different types of value, transfer it, trade it, create financial capital around assets that previously were not able to be financialized or capitalized. Does that make sense? Yes? No one is asleep yet, so I'm doing good. Excellent. But what's really exciting to me is we're still in the early days of blockchain technology. Bitcoin, right, started getting built 9 years ago. It's like we're building a plane mid-flight, and we're swapping out all the engines as we're building it because we realized, oh, we built a bunch of stuff wrong. Let's fix it. But the Bitcoin network today has around $160 billion of value on it. So you can imagine changing things in that type of network gets a little contentious, especially if people have a lot of capital invested in these networks. So I think, again, we have to be a little bit imaginative. Imagine, there are slides here. We have to be a little bit imaginative in what the future will look like. And we have to also accept that the mental models that we have today are not really appropriate for capturing what this type of technology enables. I'm super excited about the future. I hope you are too, because we're going to be able to do some really cool stuff. So let's talk about why this is happening. Okay, so everyone remembers the app boom, right? Like 5 years ago, everyone was doing an app. Yes? Yes. Okay, it was hilarious. I was making an app also, really fun. But why did this happen? Why did all these people suddenly start creating apps? There are 3 primary reasons. One of them is financial. One of them is based on technology. And the third is based on social networks. So number 1 is based on technology. So cloud computing, the advent of services like AWS and Google Cloud made it really easy to develop apps really cheaply. You no longer had to run your own infrastructure. You could outsource all of that. You could go and get server space on AWS for $1. It costs, they actually give you money if you're a startup. They give you like $100,000 to just start building stuff. So this drastic lowering of costs made it really easy for entrepreneurs to implement their ideas. So that's technology. Second is social networks. So the advent of social media, things like Twitter, like Facebook, where all of a sudden, instead of being AOL, where I had to mail a CD to every person's house every month, giving them free hours, I could go on these social sites where I could do one-to-many marketing for low to no cost, right? It was called growth hacking, I think, and there are people who've made it their life's work to growth hack effectively. But it was really a change in the way that people consumed technology. And then lastly, there was a change in the way that we injected financial capital into the startup ecosystem, and that was the rise of the operator-led micro VC. Do all those words make sense? Operator-led micro VC. So it's a bunch of people who got rich in the first internet boom, bubble, whatever you want to call it. They said, hey, I really understand web technology, and I want to fund other entrepreneurs who are building cool stuff, so I'm going to take my capital and start investing small amounts in other cool apps. And it created this whole new ecosystem of new VC firms that were really willing to invest in this type of technology. So these 3 together created this perfect storm that allowed us to have 50 different food delivery apps. So I could get a burrito from around the corner for $1. And the interesting thing was, in startup land, if things don't work out, your company fails, right? So 92% of startups fail within 3 years, and failure is typically tied to the inability to raise money or a lack of product market fit, and you could say really they're the same thing, right? It's just failure in a business sense. So that's world A. Do we all agree with that world? Yes? Okay. Again, let's go over to New World Order. So cryptocurrency 2.0 boom, what happened? For a long time, developing your own blockchain was a really costly, really difficult exercise because you had to figure out how to achieve consensus. Yay, okay. You guys are not into the game. That's okay, we'll get there. But what happened last year is this new standard was created called the ERC20 standard, which Ed actually alluded to in his talk. But basically, it was a way for people to easily create tokens on top of the Ethereum protocol. So all of a sudden, you didn't have to make your own blockchain anymore. Pretty powerful. So it drastically lowered the cost of developing your own token or cryptocurrency. Then on top of that, the crypto community has its own unique social community where we aggregate and congregate on sites like GitHub that allows people to coordinate on development. Slack, now Telegram, Discord, all of these new tools, and it allows people to do. There are some chat rooms for token projects that have over 100,000 members from all different parts of the world who all collectively are really invested in helping these projects succeed. It's pretty amazing for 100,000 random people to talk in real time on a chat room about some random ass esoteric technology. Like, can we all accept that that's a little crazy? That's pretty cool. And then the last piece, again, going back to financial capital, we have all these token funds. So you heard from Tom at Tetris. I work with a lot of different token funds. There are also a lot of people like myself who participated in cryptocurrencies early on, generated personal wealth, and are now using that to invest in these new projects because they fundamentally believe in this vision of a world where blockchains and tokens are going to connect ideas and people. So we have a similar sort of thing happening, but here's where history doesn't quite align. So in startup land, if I can't figure out how to build a good product, if I can't get people to use it, my company dies, right? Inevitably. In token land, if I have a crappy token or a crappy blockchain project, I have this free-floating, highly liquid asset that's tradable. And most of these assets trade 24/7 on platforms that don't require any sort of user registration. Right? So you've created this amazing market for people to gamble, but they call it investing. It's pretty fun. But the failure rate of these projects is unknown, because even if a protocol hasn't had any development for months and months and months, if they never launch anything useful, the token, the financial asset, can trade into perpetuity. Just think about how crazy that is. Okay, anyone in the room who's ever been an investor in financial markets and capital markets, that is insane. We've created assets that represent network value that doesn't actually have to ever be created, and it can trade into perpetuity without the approval of any regulator, of any asset issuer. This is bananas. No? Yes, say it with me. This is bananas. Okay, good. And the crazy thing is we have some projects I've invested in have over $1 billion of cash on their balance sheet. $1 billion of cash. They haven't launched anything useful yet. And not only do they have cash on their balance sheet, they have billions of dollars of tokens that they can sell in the free market at any point in time for cash. That's crazy. So if you're a VC, I would be sweating right now. All right, we'll move on. I feel like you're not shocked yet. Let's really make you sweat. All right, next slide. Okay, so does that kind of help explain why this is happening? Does that make sense? It's like a perfect storm of all these great ingredients. So here's what I want to talk about. So the venture world that we all come from is fun, and I love talking to VCs because I used to think I was a VC. And then I realized that VC is really not that fun because tokens are like crack. And I'll talk about why they're financial crack, actually. So venture moves slow and steady. So if we talk about the crypto ecosystem, did you guys like that? That was good? Okay. So venture moves kind of slowly and steadily. So what I want to do is I want to compare 2017 to 2018, right? These are 2 years. We all are on the same page. So over here I have data. I love data, I'm a mathematician. So this is 2017, this like light gray color, and this dark gray color is 2018. So this is referring to venture investing into the crypto and blockchain ecosystem. So in 2017, around 600 million deployed into equity deals. Equity, not token deals. In 2018, it was we're on pace for 557 million. Now, what's interesting is unicorns in the venture-backed ecosystem. Last year, there were none. This year, there are 2, Coinbase, which I talked about, and a company called Ripple. Now, what's interesting is Ripple's not a unicorn because they produce a useful product or service. They're a unicorn because they own billions of dollars of their own currency called Ripple. So even that's a misnomer because it's not venture-generated return. It's cryptocurrency speculation-generated return. Now, Coinbase actually has revenues to back their $5 billion valuation. The number of unique investors, I think in 2017 we had around 450, and this actually is 2016 to 2017. This is 2017 to 2018. And last year we did around 600 unique investors. So in terms of the types of people investing, there are some usual suspects, but the world of investors is starting to grow a little bit. And then the number of people that are employed by companies that are venture-backed, last year was around 1,200. And I looked at the companies I know, the 110 in the portfolio I managed. And this year it was around 2,800. So they're creating a lot of jobs, right? They're growing pretty quickly. All in all, though, these numbers are not that eye-popping, right? It's like 5, 10% growth year over year, whatever, that's fine. So let's talk about tokens, because that shit is crazy. I don't know if there are any Kanye West fans, but he has this line, that shit cray. I feel sometimes like that's the world we're living in. So again, if we look at last year versus this year, last year the total number of tokens in the market was probably around 100. This year, we have over 1,500 tokens in the market. Okay, so that is a 15x increase, orders of magnitude more. Last year, we had 2 cryptocurrencies that were unicorns, quote unquote, King Bitcoin and Baby Ethereum. This year, we had 31 at the peak. As of today, there are 26. There are 26 cryptocurrencies that have a market value of over $1 billion. Within 1 year, we went from having 2 to having 26. That's insane. And half of those projects haven't even created any utility, product, or service yet. That's crazy. No one's shocked. I feel like you guys are already, like, have you already had the Kool-Aid? Yes? Okay, good. Last year, the market cap of all cryptocurrencies in January was around 6.5 billion. At the peak on January 7th this year, the crypto market was worth almost $1 trillion. We went from this to this. That's over 100x increase in this one asset class in less than a year. Today, we're at around 460, so at around $500 billion. And then the last metric, this is the one that really, really is crazy in my view. Last year, the average daily traded volume on exchanges was around 70 million per day, which is pretty impressive. At the peak on January 5th this year, over $61 billion was traded on exchange in one day. That doesn't even include over-the-counter activity. So we went from this number to this number, 100x increase. These companies that are facilitating this exchange didn't hire 100 times more people. They didn't raise 100 times more capital. We literally saw a Cambrian explosion of this asset class. That's crazy. Like, no one is shocked. This is crazy. This is the Wild West. We're all cowboys. Get a saddle, get a gun. Like, this is where you should be hanging out. Look at these numbers. All right, no one's convinced yet. Let's keep going. Okay, so really what I want to get to is like, it's like, okay, great, Meltem. You've told us all of these somewhat interesting things. Yes, some of the numbers you presented were interesting. None of you seem that impressed, so I'm terrified as to what it takes to actually shock you at this point. Who knows? But I want to talk about what I think this means for investing, because I am wearing this shirt after all. What I think this means is this. There are really 3 types of capital that we as investors allocate when we invest in a company. The type of capital that we're all familiar with, that we all think about when we think about investing, is financial capital, right? Like, we have checkbooks, we're allocators of capital, we raise funds so that we can deploy financial capital. But financial capital is no longer valuable or scarce. As we've seen from these numbers, If I'm an entrepreneur and I want to build a project, I no longer have to go to venture land to raise money. I can raise money from strangers on the internet. I can give them no equity. I can just give them a token. It can be a security token, a utility token, a cryptocurrency, whatever I want to call it. But I no longer am living in a world where financial capital is scarce and where there are gatekeepers to financial capital. So think about that construct. That's fundamentally transformative. Secondly, I think a lot of us would like to say that we provide social capital, that our investment somehow provides a positive signal that this company is good and legit, that we can also invest our time and our energy in helping these companies, and that we build these great networks that create value. Bullshit. Bullshit. I'm sorry. I would say most VCs are no value add at best, and at worst, they actually actively destroy value because the incentives of an entrepreneur and a VC are not aligned. Your job as a VC is to make money for your LPs within a set time frame. As an entrepreneur, your job is to build the project that you think needs to exist in the world, and you will do anything to get it done. Those two goals are not aligned. One is a financial goal, and one is a human, social, political goal. They're not aligned at all, and so this incentive structure doesn't work because a lot of innovation takes more than 10 years. Some innovation may take 20 years, it may take 50 years, but removing this artificial constraint that binds VC to entrepreneur, that creates a lack of alignment and incentives, is going to be fundamental in enabling us to fund really life-changing technology that we haven't been able to fund with venture capital. Space exploration, the extension of human consciousness and human life. These are things that venture has never really invested in because it's not profitable on a 10-year timeline. But what if we had a pool of capital that had no artificial timeline on it? Just think about the types of innovation we could fund, the type of innovation that actually changes the course of humanity rather than just giving people burritos in 10 minutes from the deli around the corner. Right? That's the type of stuff I want to invest in, crazy stuff. And then lastly, the most important type of capital, I think, is human capital. Right? All of these projects, everything we're investing in relies on really great people. And in the past, VCs have built these amazing networks around them and connected their companies to their networks. But what we're seeing in the crypto ecosystem is you actually don't need an intermediary to create a network for you. And the reason I think tokens are so fun is we're trying to use something we all understand very well, which is human greed, right? Who here loves money? I love money. I'm not ashamed. You guys are all who here loves money? Raise your hand. Don't be shy. Excellent. Excellent. We all love money. It buys us freedom, right? It buys us things we need. But what if we could use greed for good? What if we could use it to motivate people to contribute their human capital to causes that were fundamentally transformative? What if by participating in a network or by working on a project, I could earn tokens? This is the new dynamic we're playing with. And again, it's imperfect, right? This is an art, not a science. We're in the very early stages. We're going to get a lot of stuff wrong. But at the end of the day, what I think is so interesting is when I walk into a bank, when I walk into a financial institution, a fund, when I meet with a 70-year-old billionaire who's been very successful financially, we have this conversation, and at the end of it, they're like, Meltem, that was great. Super interesting, super fun, but the government is going to shut it all down, right? Who here has that kind of belief? Like, oh, this is cute, but the government will never let this happen. Who here believes in that paradigm? Okay, great. A lot of people do. Here's what's crazy. This can't be shut down. This is software. How are you going to ban software? It's a question. Okay, but did that eliminate online gambling? It just drove it to different markets. How else are they going to shut it down? Tax disincentives, great. So you'll just move to another jurisdiction, right? So again, what I think is really, who here ever used BitTorrent? Napster, LimeWire, like any sort of file sharing app? Anyone? We can admit it, no one's keeping score. Okay, so BitTorrent was notoriously difficult for the government to crack down on file sharing, and why was that? It's because it was a piece of software that people were running on their laptops. How are you going to censor people from running software? So we are creating new financial software that is going to create the foundation of an entirely new investment ecosystem, one that will allow us to actually invest in technologies that may take decades to build, one that allows individuals, not just institutions, to participate in the value creation of a network, but also one that allows people to have something I like to call financial freedom. So if I want to invest in something I like to call a shitcoin, like the Jesus coin I described, all of a sudden I have the freedom to do that. And this is really the point of this technology, is having financial freedom and the ability to participate in networks that we think are valuable, regardless of what a regulator tells us, regardless of what the Fed or the investment authority tells us. This artificial constraint of having to be an accredited investor is really limiting, and it's also archaic. I could have $10 in my bank account and be more sophisticated than a millionaire when it comes to financial investing. You look unconvinced, okay. Did you learn something? Okay, excellent. So all of this is online. Feel free to download it, use it however you want. Let's do questions, conversation. So someone give me a hard question. Okay, so what I hear you saying, I'm going to sort of summarize, tell me if I'm wrong. Your sort of conclusion is there's a lot of value being created in these networks, supposedly, but there's not a lot of utility because we can't use a token to go and buy food at the grocery store. You have to remember that this technology is really, really new. So today we don't think in terms of Bitcoin at all, right? We think in terms of US dollars. And in the future, maybe we'll think in terms of US dollars. But think about the US dollar. That construct is only 100 years old. Right before that, there were union dollars. Money has been a lot of different things throughout human history, and money value can really be anything we want. It could be seashells, right? So if I came to you and I looked at your shoes and I said, hey, I like your shoes. You say, okay, and I said, what if I gave you 3 bottles of wine for those shoes? What would you say? Can I give you 3 bottles of wine for your shoes? So again, this is an artificial construct we're using. If you value wine and I value shoes, shoes could be currency, wine could be currency. It's an artificial construct that we use anyways. Bitcoin, sure, we may never denominate anything in Bitcoin, but we may also stop denominating things in US dollars. What I'm asking you to do is use your imagination, to use this, to say, what if we could rethink things in a different way? Does that mean it will be reality? Probably not, right? In our world, in the world we live in, US dollars work perfectly fine. But in other parts of the world, if you live in Argentina, if you live in Venezuela, if you live in Bangladesh, if you live in Pakistan, you don't want your government-issued currency. You would rather have Bitcoin, because if you took Bitcoin for the last 3 years, your net worth would have gone up 20x, and everyone else's net worth would have gone down because the currency's gotten devalued. Listen, anytime there is a massive creation of wealth, there is going to be scammers and con artists who participate in that and try to take advantage of the less educated, those who are speculating to make money. And again, I want to differentiate between technology and intent, right? Just because cryptocurrencies or this technology can be used for financial scams doesn't make the technology itself bad. Technology is not moral, right? Technology is a tool that can be used to do good or bad things. And so what I go back to is intent. I would like to think that 90% of the people in this ecosystem have good intent. They genuinely believe that what they're creating will create value. But I think with time, it will get regulated. It's already starting to get regulated. The G20 next month is going to be discussing regulation. FinCEN, the SEC, the CFTC here in the US are talking about it. So it will happen. But at the end of the day, it's very difficult to apply sort of gates as to who can do what and how or where. Because ultimately, I don't think we should be moral judges of what technology should or shouldn't do. It's ultimately free will that we value above all else. And so to me, preserving the liberty of people to invest and do what they want with their capital is more important than trying to create artificial barriers to entry that make it more costly, more challenging for people to enter the space. Safe is a relative concept. We continue investing in them. You continue raising money for funds, right? So safe is a relative concept. But I think, again, the idea that someone could judge whether or not a technology or project deserves to exist or deserves to gather investment capital The idea here is that that's not something that any one individual entity or government should be able to regulate. And so in the process, if bad things happen, I think that's an inevitable consequence. But my hope and my belief is that the amount of good that will be created will far outweigh the amount of harm that's done. Is the fundamental issue with crowdfunding, and I know this is an analogy a lot of people talk about, and again, I think history rhymes, but it doesn't repeat in perfect symmetry, right? So I think what happened with crowdfunding is the lack of liquidity in the assets people were buying, particularly in equity, made it just like venture, right? Like AngelList, I use AngelList for some of my investing, but it's not any different than signing a safe. It's the same stuff, just on a different platform. So it didn't actually change anything structurally about how investing worked. What we're doing here is we're saying, look, instead of giving you a safe and you signing, let's say you put in $50,000 and you sign your little safe and you wire your money, and then you just sit there and hope stuff turns out okay. What we're saying now is instead of you getting this piece of paper, right, a share certificate or a safe that hopefully turns into value, you get tokens. You get these assets that are tradable, they're fungible, and you can trade them 24/7. There's liquidity around them, right? Today, some assets are thinly traded, but people are looking at market making, underwriting, adding all sorts of new critical needed infrastructure to create that liquidity. But now all of a sudden, if you look at a company and you're like, oh, you know what, I don't think this is gonna work out, you can sell your tokens. You can take a markup, you can take a mark down, and you can do it in real time. So that's fundamentally different. We have this new technology that we haven't had before. Now, the law hasn't quite caught up yet, so I think it'll be interesting to see how regulators respond and what it means for some of the rules around equity investing. But I do think now that we have this technology, it has fundamentally changed how people think about liquidity and some of the constraints that limited the effectiveness of crowdfunding. There's an element of that happening. All right.
Okay, last question.
Ed, you're over here with a microphone. Do you want to jump in?
Somac, how about here?
All right.
He's got the last, Somac's got the last question.
All right. Make it a good one. Make it a good one. Hi, I'm Meltem.
Hi, Meltem Demirors. Really, really enjoyed your talk.
Oh, thank you.
So, can you hear me? Or can I just
Yeah, just
so basically,
shout it out.
so I really found this presentation fascinating, but I wanted to go to your point about, well, actually, you're sure venture capital is dead. By the way, I believe all of our industries will be disrupted. So I know I'm not going. I'm maybe a robot will one day do my job. I'm not. I know that I hopefully have a few more years left, but I believe that I still believe there's an opportunity here, right? But I.
Given that venture is dead, this will be our last VCs on skis, by the way.
So I know. Hopefully, my current fund does well enough and not to worry about. I'll be doing
raise a
investing in
crypto
Bitcoin.
fund, you'll be fine.
Crypto fund. But the thing is,
Change form,
I feel
shapeshift.
like the phrase is incendiary. But I feel that I don't feel when you talk about all these platforms creating liquidity, new forms of capital. These are I feel not necessarily just disrupting venture capital. I feel it's really basically helping fill a void that's not really being served by banks, by foundations, by all these people who have done things that are not that 10-year timeline, right?
Yeah.
So, but I think the one thing that you actually there was a slide you had earlier that talked about you talked about like the signaling, the social capital.
Oh yeah, the go forward later. That last slide.
So the one thing that I
That
feel,
one.
yeah, right,
Go
right,
back,
that
yeah.
one, right?
Perfect, yep.
So I do think that captures a lot of the elements of how you look at investment capital. The one thing I feel it doesn't address, though, is the issue related to how venture investors are professionally vetting these companies. But what we're focusing our time on is going deep into not just customer diligence, like the human capital assessment, kind of focusing on is this person saying something that's truthful. That's pre-investment, but post-investment, dealing with the governance, figuring out is this person doing what they're saying they're supposed to be doing, who has to be hired, who has to be fired. We're now all representing shareholders, right? And so, and as the CEO.
Can I ask you a question?
Yeah.
Slightly different question. So how many portfolio companies do you have as an investor?
8 right now, yeah.
8, okay. Okay, so if I went to your 8 portfolio companies and I said, what do you think of him as an investor? What do you think they'd say about you?
I think some people would say, well, I would say if you have a drink, hopefully they'd say I was a good investor, but sometimes like, this guy Somac, he keeps asking me about these models, he's like getting in my hair about this and about that. I bet they would probably be there'd be certain things like if I didn't have to deal with these people, not all of them, I think they understand the benefit of a lot of other things we do, but I think that I have heard entrepreneurs, not necessarily mine, but others complain about the challenges that VCs have. And in fact, sometimes they are destructive. There are a lot of bad apples in the industry. There's a lot of, so
I would say at best, I hope to be, so I have 40 portfolio companies. 6 of them are traditional equity and the others are tokens, and I work with all of them in different ways. But I would think my goal as an investor is to be as minimally disruptive as possible. Right. And I always ask my projects, I'm like, hey, send me like an update once a quarter. If you want to chat, let's chat. Some of them call me all the time and ask me lots of questions and for lots of help. Some of them are like, hey, just let me do my thing and I'll talk to you later.
But I'm saying is that, are you saying that I'm just saying that for venture investors. So you said you've invested in equity investments. So you're saying you're ascribing no value to the focus and experience and skill set of vetting entrepreneurs.
Right, but
the
difference is if you're investing someone else's capital, you're an agent. If you're investing your own capital, you're a principal. To me, being a principal is fundamentally different than being an agent. Investing your own money will always carry more gravity and more weight for people than allocating other people's capital. With people now allocating their own capital, if I put 10% of my net worth into a token that represents some sort of longevity project, or say some form of private money, right, that circumvents government control, my incentives fundamentally change. Now contributing, because I contributed financial capital that's meaningful to me personally, I now am incentivized to contribute social capital, human capital, intellectual capital to this project because I am I'm my own principal. I'm not an agent for someone else's capital. And I think this is the idea that's really disruptive because in venture, it's an occupation, right? When you are done with your job, for a lot of people, you go home and you're done. But you and I both know that you're never done. Being an investor is a 24/7 job. And so I think, again, it's not to say that investing isn't a valuable skill set. And I think some of the models that are emerging is, look, a venture fund doesn't necessarily need to go out and raise dedicated capital from a group of LPs. What if you could crowdsource a fund where instead of you being a professional investor, you are a curator, right? And you are one of the people who's responsible for identifying investment opportunities and serving them to people in a curated way. Right, this is what venture investing platforms tried to do. It's what AngelList tries to do. So I think the construct for how venture investing will work changes, but I think there is a fundamental shift that happens when someone goes from being an agent to being a principal. And that's what's really powerful, because it changes the way that people think about their investment decisions.
I really enjoyed it, Mel. Thank you so much.
I'll let Ed do that.